Welcome to the Techno Fundamental Report for January the 19th. Last week we talked about the Old Testament and how human behavior really stays pretty consistent throughout history. So if we go back and look at the Roman Empire, I think this is always interesting. This is a very interesting study. It's how they devalued their currency by 90% over 1,000 years. And so it was the greatest and most influential civilization in the world. Lasted 1,000 years. You can see where they started out with silver coins that had 3.5 to 4 grams, but by the end of the empire, they had removed 90% of the silver and pretty much had lead coins. So if you really think about the United States, we're approximately 250 years old. And, John Maynard Keynes said, in the long run, we're all dead. So, if the Roman Empire lasted 1,000 years and we're 250 years into our civilization, can we go 750 more years? But in the long run, we're all dead, so it doesn't matter. I think these people that run our government and run governments believe in this concept called modern monetary theory. And it's a macroeconomic theory that says that countries that control their own currencies, like the U.S., are not constrained by revenues when it comes to government spending, which means they're going to print money. So what does this all mean? It means that we've got inflation. Jamie Dimon really called this earlier in the year. He said that, there was only really one reason the stock market has gone down, and that's because interest rates, now this is the 10-year Treasury, is because interest rates went up. Now, the stock market went down. So if you don't want to overcomplicate things by saying, well, so-and-so's president or so-and-so's in the Congress, or whatever. Interest rates and corporate earnings are the most important factors. So let's take a look at the market, see how we're looking here. This is NASDAQ. Again, we got a nice rally going here. We got above the lower moving average, which is pretty much, hasn't turned up, but flattened out. Never got above the 200-day, and as of yesterday, we had a pretty decisive pullback yesterday. Now, we also need to note that the 200-day moving average continues to be challenged. Okay, we got what we call a bear market rally. We're getting another rally here, but the interesting thing that's a little different this time is that we've got lower lows. We're just not getting higher highs. The other problem we've got, though, is the NASDAQ is not participating as well as the S&P. We need to get the NASDAQ going. Now, volatility, if we look at volatility as just using a 50-day moving average, you can see that volatility is declining. Now, the current reading is 20.34. So basically, volatility is declining, which is a good thing. Now, the other good news here is we've got a somewhat of a reversal working here on the aggression index. Now, this could be temporary, just like the 200-day could be temporary, but also this aggression index is also challenging that 10-week moving average. So this is a weekly moving average, and we're seeing some improvement here. So if you go back and look at like 2019, you can see the improvement, and then, kind of back and forth, but then we finally broke out, and after COVID was kind of realized in April of 20, this is what we're looking for. Hopefully this indicator gives a buy signal. The buy signal comes if we get above the lower moving average and the lower moving average turns up, which the lower moving average, if anything, is just kind of flattened out. Now, I really think it's interesting right now with all the talk about higher interest rates and inflation and recession and all those things. The 10-year Treasury note is about to break the 200-day moving average to the downside. We're at 3.3, 3.4 on the 10-year Treasury, whereas back in October, we got up to 4.2. So interest rates are actually declining. Price of oil continues in a downtrend. We'll talk a little bit more about that in the video. And the financial stocks have gotten back above the 200-day, a little bit of a pullback yesterday. The only other good news here is another primary indicator that we use is the number of new lows on the New York Stock Exchange. Again, we use lows instead of highs because during a bear market or coming out of a bear market, new highs are going to be very rare and hard to find. However, we have now gone 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days below 40 on the new lows. That's a buy signal because it's 8 days to get the buy signal. Now on the NASDAQ, the new lows are showing some improvement as well. Look how these things are coming down. All this means is that the sellers are drying up, but the buyers need to come in. Now on sentiment, I do want to emphasize what my biggest concern is. You see this spike in the VIX? That's capitulation. I'm seeing signs of capitulation out there. In other words, you get a long period here of pessimism, which remember now, this is the AAII survey where they survey their million-person group and they ask the question, are you bullish or are you bearish? And when everybody's bearish, you're below the zero line. And you can see here back in the '08 crisis, we were negative for quite a while. Here's COVID. And here we are now. We're over 40 weeks negative. Now, what I'm worried about is that we do get a capitulation here. But the good news about capitulation is, just like back here in '09, that's where the bottom was put in. So hopefully that's what we're dealing with here. Now, on the bond market itself, which this is corporate bonds, you can see much improvement in corporate bonds, telling me that maybe we're not going to have a recession. I've been doing this a long time, and I've never heard or seen a advertised recession. They usually come out of the night and out of nowhere. This is home construction. You can see where home construction stocks are picking up. This is the Treasury bond, the 20-year Treasury bond. You can see it's picking up as well. So it's going up because interest rates are coming down. And hopefully inflation has peaked. Now we're going to take a look at one fundamental story here. This will be Schlumberger. This is a drilling service company, mainly seismic services. It's an $81 billion company, does pay a dividend, which we'll look at. In an uptrend, looks good. They're based in Houston, Texas. It's a French company originally, but they're based in Houston. Now, if you look at the weekly graph, you can kind of see here that, it's stabilized, got a nice little base going here, and then broke out of that base. This stock looks pretty good. Now, the main thing that's going to drive the oil stocks is the price of oil. So this is West Texas Intermediate crude, downtrend, however, starting to kind of poke up a little bit. So maybe the oil stocks are going to continue to perform. Schlumberger, let's look at the numbers on Schlumberger. As of most recent reported quarter, their profit margin is 11%, which is very good. Return on equity is 19%. They have positive cash flow, which means to me that they're able to handle the debt that is on the books. The books, right now on the books, there's $13 billion in debt. However, they have enough cash flow to service the debt, and they've got about $3.6 billion in cash. Current ratio 1.4, which is not as healthy as I would like. I would like that to be more like 2-to-1, but still good. Revenues were up 27% in that quarter, in the most recent quarter, and earnings were up 65%. So this is a pretty solid looking company. I don't think they're going out of business anytime soon, but that's the main thing you're trying to accomplish with this type of analysis. You're not trying to project anything. You're just trying to say, is this a healthy company? Is this a well-managed company? So the way you have to look at return on equity is, it requires debt to get that kind of return on equity, because when you finance with debt instead of equity, the remaining equity continues to benefit from the total capitalization. So if you're a CEO of a company and you say, okay, we're going to borrow $13 billion and get a 19% return on equity, I think that's a sign of good management. So if you would, let me know if you have any questions. Thank you very much.